Thanks, Akshay. Morning to and good afternoon to all participants. I'd like to thank JK Tyres management for giving us the opportunity to host the call. We have with us the senior management represented by Mr. Anshuman Singhania, Managing Director, Mr. Arun Bajoria, Director and President International Business, Mr. Anuj Kathuria, President India Business, Mr. Sanjeev Agarwal, Chief Financial Officer, and Mr. E.K. Kindra, Financial Advisor. So without wasting any time, I'd like to hand over the call to Mr. Singhania. Over to you, sir.
A very good morning to everyone. Thank you for joining JK Tyre Quarter 2 FY2024 earnings call. I am Anshuman Singhania, Managing Director, and I have with me Mr. Arun Bajoria, Director President International, Mr. Anuj Kathuria, President India, and Mr. A.K. Kindra, Financial Advisor, and Mr. Sanjeev Agarwal, CFO of the company. On behalf of the JK family, I wish you all a very happy and prosperous festive season 2023. It is with immense pride to share with you all that JK Tyre secures the best-in-class ESG grading for the second consecutive year. This signifies our strong commitment to become an environmentally conscious organization and also reinforces our vision of be a green and trusted mobility partner. Quarter 2 was another strong quarter with record high revenues of 3,905 crores with a growth of 4% as compared to the corresponding quarter, driven by sustained demand momentum in the domestic market. Operating profitability doubled to 597 crores over the corresponding quarter, with EBITDA margins hitting the multi-quarter high at 15.3%, which was led by improved operational efficiency, enhanced product mix, further supported by raw material prices. Strong domestic fundamental continues to provide tailwinds to both automotive and tire industry during the quarter as well, resulting into JK Tyre's domestic volume growth of 8% over the corresponding quarter, contributed by robust OEM and replacement growth grew by 18 and 7% respectively over the corresponding quarter, despite export demand being low. Festive season driven robust demand for the automotive industry will provide a continued impetus to the tire sector. CV sales continued to witness a growth owing to investments in the infrastructure sector and high economic activities. PV sales continued to be on an uptrend during the quarter and reached new heights owing to strong demand for the SUVs. Also, we are witnessing some green shoots in the rural markets, resulting in the pickup in 2-3-wheeler sales. However, domestic tractor sales remain muted during the quarter. As the Kharif sowing is on the track and with an overall favorable monsoon, tractor sales are expected to recover slowly. We are increasing our participation with OEMs and presence in the replacement market by offering premium products across the segments. Export sales recorded a healthy double-digit growth over the sequential quarter. Consolidated exports stood at 654 crores, which is up by 11% over the previous quarter, primarily led by higher volumes. We are watchful of the global demand sentiments and further strengthening our presence in Americas and Middle East markets. On automobile and tire sector outlook, demand momentum continues to remain steady in the domestic market on the strength of promising economic outlook of India in the near to medium term. We believe the pickup in the private sector capex going forward will further boost the overall economy and demand momentum. On the channel development, we are increasing our brand presence through increasing JK Tyres exclusive brand shops to penetrate deeper into the domestic markets and cover all white spaces. Fleet management and mobility business is another important area where JK Tyre holds a competitive edge advantage in terms of offering superior customer services. We are adding large fleet customers to capitalize on the opportunities emanating out of rising economic activities and higher fleet utilization in the country. We are proud to share that JK Tyre has partnered with 1,300 plus large fleets in the country under the fleet management program. This is an important business vertical area for us and would accelerate going forward. Our financial performance has improved significantly in terms of overall profitability, lower debt levels with better return ratios. We are striving towards our strategic priorities of undertaking capex judiciously in order to capture growth opportunities with sustained focus on reducing leverage through debt reduction and better working capital management through improved profitability. Now I would request Mr. Arun Bajoria ji to talk about the performance of JK Tornel Mexico.
Thank you, Anshuman ji. The performance of JK Tornel Mexico continued to be resilient in terms of overall revenue and profitability in Q2 of FY24. JK Tornel achieved a turnover of rupees 712 crores, flattish on year-on-year basis. This has been achieved despite headwinds faced from American continent on account of influx of tires from Asian countries as well as the appreciation of Mexican peso to a dollar by nearly 12%. Recently, there has been an imposition of additional import duty of 10% on Chinese tires and all other Asian countries on PCR and light truck radial tires for the next 2 years. Operating profits, EBITDA, stood at rupees 57 crores, lower by 11% on year-on-year basis. Mexico's economy sent a signal of moderation and in July recorded a growth of 0.2% monthly from the 0.5% which we had reported in June. However, investment levels in Mexico have surged upwards so far this year and sentiment from the private sector is at its highest level since 2015, driven by a better perception of the performance of the Mexican economy and near-shoring. Fortunately, gross fixed investment represented 24.3% of GDP in the first half of this year, the highest figure since 1993. These pointers are a good sign of the future of Mexican economy. Inflation continues in a downward trend in the quarter ending September 23. It stood at 4.44% annually at the end of September 23 from nearly 5% at the end of June 23. I am happy to share that JK Tornel has secured 5-star certification and recognition from the British Safety Council for Occupational Health and Safety. Now I would request Mr. Agarwal, our CFO, to brief about the financial performance of this quarter.
Thank you, sir. Thank you very much. Let me briefly share with you the key highlights for quarter 2 FY24. The first one is on the sales. Consolidated sales were recorded at rupees 3,905 crore vis-a-vis rupees 3,764 crore in Q2 FY23, which is up by 4% on YOY basis, which is primarily driven by volumes. Profitability at EBITDA level in Q2 was recorded at rupees 597 crore as against rupees 305 crore in Q2 last year, an impressive increase of about 96% on YOY basis. Operating profit margins were recorded at 15.3% on consolidated basis, and which has expanded by 280 basis points over the corresponding quarter. Cash profit for the quarter was rupees 488 crore, which is significantly up as compared to the corresponding quarter by 150%. Profit after tax was rupees 249 crore, a multi-fold increase of 5x on YOY basis. Capacity utilization levels have remained high at 87%. Consolidated exports stood at rupees 654 crore, which is up by 11% on sequential basis. Subsidiary companies, namely Cavendish Industries Limited and JK Tornel, Mexico, have continued to perform well and have contributed significantly to the revenues and profitability on consolidated level. Cavendish posted a top line of rupees 928 crore with EBITDA of rupees 144 crore, registering an operating margin of 15.5%, and profit after tax stood at rupees 49 crore. Earnings per share improved to 9.33 per share as against rupees 2.08 per share last year. ROCE and ROEs have improved significantly in Q2. Net debt stood at rupees 4,087 crore as on 30th of September 2023, a reduction of almost about rupees 431 crore as compared to March 23, which is led by scheduled repayments of long-term loans and improved working capital levels and higher cash accruals. Leverage ratios have improved further over March 23, so net debt to equity improved to 1.05x in Q2 as against 1.29, which was there as at the end of March 23, and net debt to EBITDA improved to 2.27x as on 30th of September as against 3.39 as at the end of March 23. A significant improvement in leverage ratios. The capacity expansion CapEx under implementation for TBR and PCR tires are progressing well and as scheduled. Thank you. These are some of the key highlights. So now we are open to take up questions. So one by one. So back to ISEC team.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Nero from Living Root Analysis. Please go ahead.
Yeah. Hi, sir. So, could you shed some light on the margin? Like, what could we expect the margin for the next 6 months or so? Like, at what crude level are we comfortable to maintain the current margin level?
Right now we have our margin levels as I said in the speech, and plus Mr. Agarwal ji said that our margins have reached 15.3% with operating profitability doubled to 597 crores from the corresponding period is our EBITDA. This going forward would sort of I would say maintain, and because now what we are seeing is that the raw material prices going forward, we are seeing that we are expecting a slight price increase in the raw material prices of 3 to 4%. And the crude oil prices has been varying, but we are not seeing that much of a spurt which will impact.
Also, but during Q2, the crude prices were relatively less. So at what crude levels going forward we can maintain the 15% margin?
So basically, I think we have been seeing the crude to be slightly volatile recently, but I believe that between 85 to 95 range of the crude level, it should not impact us much.
Okay. So if the crude is within that level, we can reach the December 20 EBITDA margin level of 18%?
18%, are you saying?
Yeah. Like, is it possible to reach the 18% level, which was achieved in December 20?
See, we have been working all the way actually right from the increase in efficiencies, improvement in the tires premiumization, and also innovative products which we have launched in the recent past in the last 2-3 quarters. So we are trying to improve upon the margins on a sustainable basis. But that is subject to, of course, the softening and the raw material prices remaining in the range. So I would not like to say that what kind of margins we can get in the next few quarters. But yes, we are very optimistic that we will be able to get much better compared to what has been the history actually.
There are several geopolitical factors at play. It is very difficult for anyone to make any proper guesstimation at this stage of, like, see how many is war and all that. But as I think, as Mr. Agarwal is saying, is very right, that we will put in every effort that we are able to sustain the margins.
Okay. So 80 to 90 level is comfortable. And so what's the current capacity utilization?
87%, as we said.
87. Overall, the 87% utilization.
And so what about JK Tornel? And on a standalone basis too?
Yeah, it is about 83%.
And standalone would be 95%. JK Tyres.
Okay. Thank you, sir.
Thank you. The next question is from the line of Aditya Rati from Equities Investment. Please go ahead.
Yeah, thank you for the opportunity, and first of all, congratulations on a very good set of numbers. So, my first question was again related to margin. So, in the opening remarks, you mentioned that margin increase was because of product mix and raw material price going down. So, I wanted to understand how much of the contribution in margin has happened because of improvement in product mix?
Yeah, I would like Katuriyaji, would you like to take this question?
Yeah, so, the improvement in margins as we see with the sequential quarter is around 280 basis points. So here it's a combination of various factors. Definitely the raw material prices have further softened. The raw material prices, if I remember correctly, has come down around 5 to 5.5% for the quarter. That is one. The other is that, as Sanjeev Agarwalji also said, that we have been working diligently on the premiumization and offering better innovative products to the market, especially in the PCR segment. One is our capacity utilization has been at its peak. Second, we have also been able to get more tires, which are of the higher rim sizes, 16-inch and above, has also grown significantly. That those products are actually having better margin returns. So that also helps us not to undermine the continuous drive on operational efficiencies that is being worked. We have been doing a lot of work on tech-enabled manufacturing. That is also giving us the returns. So it's an all-round combined effort, and also selectively we have on certain SKUs, we have also taken some price increases, but that was on selective SKUs. So actually, if you see all the boxes that are required, are being ticked. And one more point is that the current expansion that is happening in Banmore, which was announced, the capex for which was announced last year, 530 crores, that is also giving us the capability to go and produce more tires of the higher rim sizes. So going forward also, that will help in further premiumization of the PCR segment.
Got it. Fair enough. And secondly, again, if I see at the gross margin level, and if I compare it YOY, so our RMC last year for September quarter was close to 70%, and it has dropped to now 60%. So there has been an improvement of 10% in gross margin. But the similar level of improvement has not happened in EBITDA margin. And if I can see, the most glaring increase is in employee cost, which has kind of sustained over the last 6 quarters. So at what level do we see this employee cost stabilizing? Because in this current quarter also it has increased by 26%, whereas our revenue has grown only by 3%.
No, you are right. There has been a reduction in the gross margin from almost about 70% to 60%, and which has eaten away somewhat through the cost increase in the probably in the finance cost, not in the finance cost, but the other expenses and also the employee cost. So that is because of the larger volumes which we have produced as compared to quarter 2 of last year, and also the annual increase which has taken place during this, and some of the long-term agreements which we have signed with the laborers and workers at some of our plants. So these are some of the reasons which have partially offset the benefit which could actually be there in the increase in profitability.
So, sir, at what level do we see this stabilizing? Because again, this quarter the employee cost was up by 26%, which is kind of quite significant.
As I said, because of various reasons for the employee cost. It's not that the annual increase which is considered is very high, but basically this is because of the increase in production levels also. So the production level, the higher the production level, the cost will go up.
Right. But YOY, if we see the volumes, it is in single digits. So the production volume has not significantly increased in tandem with employee cost.
So that is because the impact of the benefits will come over the period. So because some of the long-term agreements also have gotten into effect, so that is going to get the benefit. So this is for long term, like 3 years. So for next 3 years, we will not see any increase in the contract cost, in the cost of the workers. So this benefit will be there over the period.
And lastly, sir, my question was around the capex plan. So as you mentioned, the second phase of PCR is currently on, and TBR is also 260 crore TBR. So this is expected by end of fourth quarter this year?
So both the projects are progressing well, and in fact some of the capacities have already come into commercial production, and these are being ramped up. So in the case of, for example, in the case of TBR, the ramp up will get completed by the end of this financial year. And also for PCR, probably it may be in the very first month of the next financial year. So we are trying to, let's say, ramp up everything under the ongoing capex within this financial year broadly.
And so what would be the total contribution to revenue for in relation to this two capex specifically?
So we have discussed this earlier also, because these were the capex which we had undertaken, and for balancing our equipments already there partly. So this is going to give us the revenues in the ratio of about 1.2 of the investments made.
Okay. And now we have announced one more new capex, of 1,000 crore almost, having an execution of close to 18 to 2 years.
Right.
And in which segment have we announced this capex?
So this will again be broadly in the PCR segment, because there is a very good growth in the PCR segment in the domestic market, and also in the overseas market we are getting opportunities with the expected anti-dumping duties against the other Asian countries as well. So we are expanding capacities, and we will be expanding in the PCR segment, very largely in the PCR segment.
Got it. Sir, I'll thank you for answering all my questions. I'll come back in the queue.
Thank you.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal. Please go ahead.
Hi, sir. Congrats on very strong performance. Continuing on the question on the capacity addition which we have announced, so what kind of PCR capacity addition will this lead to?
We have announced 1,025 crores, and we are looking at expanding the capacity by 20%. From our total available capacity of 15.5 million tires per annum.
Yeah, the quantum of capacity addition in PCR segment, since this is only for PCR, what kind of capacity expansion is happening for PCR is my question.
So this is actually the broad announcement which we have made, and the plans are under consideration, and we are working out all these details further. But very broadly, as I said earlier, the expansion is going to be majorly for the PCR, but other segments also will get covered.
Okay. Got it. And second question pertains to this 8% volume growth in the quarter which we have seen in the domestic market. Can you give breakdown between the growth in domestic replacement and OEM, as well as what was the decline in the export and the volume side on YY basis?
We have actually in the domestic market witnessed a volume growth of 8% over the corresponding quarter. In the replacement market, our volume growth was 7%, and in the OEM we grew by 18%. And in the domestic market, in the passenger vehicle and commercial vehicle tires, we witnessed a volume growth of 9% on a year-in-year basis.
Okay. So you indicated OEM growth of 18% and replacement of 7%, and despite that, our overall domestic volumes grew by about 8%, which in that context looks a bit low. What am I missing over here?
Sorry, I didn't get your question.
आपण ज्या व्यक्तीसोबत बोलत आहात त्या व्यक्तीने आपला कॉल होल्डवर ठेवला आहे. कृपया लाईनवर रहा. The person you are speaking with has put your call on hold. Please stay on the line. आप जिस व्यक्ति से बात कर रहे हैं उसने आपकी कॉल को होल्ड पे रखा है. कृपया लाइन पर बने रहें.
Hello?
Hello. The next.
Yes.
Thank you. The next question is from the line of Bharat Bagnani.
No, there was some question pending, I think, from.
Got disconnected. He put himself in the hold. Can I take the next question, sir?
Yeah, please take up.
The next question is from the line of Bharat Bagnani from Living Root Analytics. Please go ahead.
Yeah, hi everyone. Good morning. I just wanted to ask Sanjeev ji. Sanjeev ji, I think you had mentioned a couple of quarters back regarding the tax rate. So
Yeah.
by when can we see the tax rate coming down? I mean, is the entire thing absorbed by now?
No, so I think we will be able to absorb the net credit by the end of this financial year. And from next financial year onwards, because we cannot adopt this in between. And in any case, there is some unabsorbed net credit available. So that will get completed by this financial. From next financial year, we will see a new rate of tax.
So it'll be that 26% range, 25, 26.
Yeah, whatever the applicable tax rate in that financial year would be, that will be applied.
Right. And you also announced recently, I think yesterday, that you are going for a capex increase. You're doing a capex to increase the capacities. So these will be, like you mentioned, primarily in the PCR segment, PCR radial segment. But I think, are we utilizing our current capacities fully?
Yes, absolutely. So I think it was clarified earlier by Anshumanji and Kathuri. The 95% of our capacities are utilized at the moment.
Okay. So this can go up to 100, or this is where we are at currently? This is where we'll be at, the current capacity.
With some tweaking, of course, which continues from quarter-on-quarter basis, month-on-month basis, we continue to do that. So we can still have a better capacity utilization going forward. But the new project is also coming up, rather has come up and ramping up is happening.
Hello?
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 Yes, please go ahead.
Some disturbance in the line?
Yes.
Yeah, there was some disturbance. So I was saying that the capacity which we have just commissioned and is under ramp up of 530 crore project, so that will also be available to us. So we have enough headroom, and then we will take up the new project as well.
Okay. And this will be an existing plant itself, right?
That's correct.
Right. The final question is, that we primarily being a leader in the TBR space, we are now focusing our energies, I think after Mr. Anuj has come in, towards the PCR segment, more towards the PCR segment. So I think then what are we looking at, couple of years down the line in terms of revenue mix? We want to bring the TBR cyclicality down, or, I mean, what is the idea behind now focusing on PCR more?
Just to clarify this point, while the focus will be on PCR, it doesn't mean that the focus on TBR is not there. The focus continues to be on TBR also. In fact, if you see our plant, Luxor plant, we are already having the capacity. Our participation with the OEMs has gone up. Our reach in the replacement market is also being enhanced. Also, we have been launching some power SKUs. Why we call them power SKUs? Because these are SKUs which will be giving better value to our customers. To give a few examples, the fuel efficient or the fuel saving tires, XF series, the extra mileage series, XM. Specifically, we have now started designing tires for the mining application, because we understand that mining applications are becoming more stringent. So XD series. So there is a lot of focus on TBR as well. And I would say that rather than, it's not either or, it is an and. We will be focusing on TBR, and we will also have an enhanced focus on PCR, because there the headroom is even better.
Got it. And I think in a recent research report that had come out, it had mentioned that, your Vikrant and Challenger brands, the proportional revenue from them have come down significantly. So are we to say that these will be phased out, and you're not keen on continuing the low-end brands which were essentially competing with the Chinese imports?
No, we are increasing our premiumization there, and these brands were created for some other purpose when there was a lot of Chinese influx, and now we are treading on a higher mix and premium mix. So going forward, we are anyways enriched our product mix, and going further we will be enforcing our premium mix with our JK Tyre brand.
So finally, Anshumanji, then one thing, in the PCR also, then are we looking at rim size of 15-16 inch and above? I mean, yes. Then we are not looking at anything below that, right? Because that's a very competitive space again.
No, we are catering from 12 inch up to even 18-19 inch, and we are also participating with OEMs in the lower rim sizes as well. And that also holds a good market right now in the aftermarket as well. We will be continuing to cater to this smaller rim sizes also, and we will increase our ratio going in the higher rim sizes.
Okay. Thank you so much. Thanks, and all the best.
Thank you.
Thank you. The next question is from the line of Vishal from SVAN. Please go ahead.
Thank you for taking my question, sir, and congratulations for a very good set of numbers. Sir, I have one question regarding the raw material basket. You said that for this quarter, you are expecting around 3 to 4% increase in the raw material basket. And you also said that you would try to maintain your margin trajectory at a similar level seen this quarter. So, sir, where are we seeing this delta come from? What is your strategy? It will come from price increases, product mix, geographical mix improvement, something like that. So can you throw some light on how will you able to cope this price increase and maintain your margins? That is my first question.
So, yeah, very well. You heard that right. Well, our margins will remain sustained because of various reasons. Because as you heard that, our increase in premiumization of products across segment. For example, in the PCR, the higher rim sizes, then we have introduced a lot of new products in the PCR itself, and then truck radial as well. We have introduced the fuel saver and the XS series, and then the XM series. That is one. The other thing is that we are seeing the demand to be quite robust. We will be catering into this demand. Wherever we are seeing opportunity in terms of our selling price increase, we will be doing that. Our capacity utilization has been at a very good level. So our efficiencies are also panning out. So these are some of the areas in which we are focusing, and we will see that this set-off of expected raw material price increase could also set that off.
Okay, sir. Sir, my second question is regarding the demand scenario for your international businesses like Concall and Cavendish. How are you seeing in near term how the demand is shaping up in the international market?
Well, in the international market, first of all, that we are seeing that the worst is sort of behind us. There has been some signs of normalization in the channel inventory and improving customer confidence and business sentiment. There has been in some markets cooling off of the inflationary pressures. Also, the interest rates have peaked out. So we are making continuous efforts in terms of our expanding in our global market presence. And we are seeing that there will be improvements going forward in the H2 FY24.
Okay. Thank you so much, sir. Thank you, and all the best, team.
Thank you. Thank you, sir.
Thank you. The next question is from the line of Mitul Shah from DM Capital. Please go ahead.
Thank you for the opportunity, sir, and congratulations for a very strong performance. Sir, first question is on the export side from India. Export, either in terms of value or volume terms, how much decline we have witnessed in Q2 compared to last year Q2?
Sorry, can you be slightly louder, Mitulji?
My first question is on export side. Export, if you can give either in value terms or volume terms, Q2 versus last year Q2, how much decline we have witnessed?
Okay. So at India operations level, if you are talking about only the India exports, then there has been some about 10% decline. 6% decline in this quarter.
But on a quarter-on-quarter basis, in value terms, there has been 26% increase, improvement.
And that is why Anshuman ji just said that all the worst is behind us now, and we are seeing an upward trajectory.
Just to add, last year, if you see the 4 quarters, quarter 1 and quarter 2 was quite okay for exports, but in quarter 3 and quarter 4, the demand had fallen sharply. Now in quarter 1, we saw some recovery, and quarter 2 has again been better. As Anshuman ji said, quarter 2 was 26% better than quarter 1. So going forward, we expect that quarter 3 is generally not a very strong quarter for exports because of the year-end change and all that. But quarter 4 onwards, we expect that the demand should be robust. The only thing which we'll have to watch for is the geopolitical situation, that is, which way it goes.
So this 6% decline in volume or value?
Value decline.
Value. So second question is on this new capacity addition and CapEx. As we are highlighting more focus on the PCR in this incremental capacity, and that too again is focus towards the higher inch ring size. So what could be the revenue potential once this entire new plant goes at a close to 100% utilization? Incremental revenue.
Revenue from the new project which we are envisaging to set up will be 1:1. Revenue will be 1:1. So whatever investments we are making, almost equal amount of the revenues we will draw from that.
And so can you give roughly ballpark number in terms of a revenue breakup likely between the PCR and non-PCR in this incremental capacity?
No, so as I said earlier, we are still working out the details, and we have decided to invest about 1,000 crore rupees, and the details will follow, and we will inform you in due course.
So lastly, on this capex side, this 1025 crore would be spent over next 1 year from this October to...
Not in 1 year. Dear, it just takes a lot of time nowadays to set up capacity because the delivery of the equipment takes almost about 15 to 18 months time. So we are expecting that the complete setup, commissioning of the project will take about 2 years.
So 500 crore roughly incremental capex for 1 year, like, and existing capex already we are in the range of 400-500 crore. So broadly, overall capex would be 1,000 crore per year for next 2 years. Can we assume that?
Yes, that is right. But on the existing capex which are undergoing at this point in time, most of the capex has already been done. So maybe some amount of capex payments and other things will continue into the next financial year. But okay, you can take about that number.
Sir, and last, this QIP, any timeline, any indicative as per your internal assessment?
So we are preparing the relevant requirement. We are preparing papers for that. So, but we would like to maybe target within this financial year, I guess.
Yes, sir. Thanks and all the best.
Thank you.
Thank you.
Thank you. The next question is from the line of Tushar, an individual investor. Please go ahead.
Yeah. Hi, sir. Good morning and congratulations on the great set of numbers. My question is on the capex side actually. If we see in the latest quarter, our cash flow generation is roughly around 350 crores. And for the entire year, we can roughly generate 1,100 crore cash. And accordingly, for the over the next 2 years, we can generate 200 crore cash, and which is more than sufficient for 1,000 crore capex that you have just announced. Then why are we looking at to dilute equity to raise 500 crores?
Good question. So this is, I think, to strengthening our balance sheet further and deleverage the company, as this has been a point of discussion all the time, that the company's balance sheet was slightly over-leveraged in earlier years, not now. In the last 2 years, you would have seen a lot of improvement there. So we would like to further maybe reduce the debt side of it. And also because we are undertaking the capex of about 1,000 crore rupees, so this could be a mixed use of the capex and also the strengthening of the balance sheet and other general corporate purpose.
Okay. Okay, sir. It is also my humble request to the company to maybe wait for the higher price to do this QIP, as our company valuation is much lower compared to peers. Thank you, sir.
Thank you so much for suggestion. Thank you.
Thank you. The next question is from the line of Jyoti Singh from Aryan Capital Market. Please go ahead.
Yeah, thank you for the opportunity, and sir, congratulations on the good set of numbers. So my question is on the EV side. So sir, if you can, could you provide about the current market share in the EV tire segment?
Well, we are very focused on the EV, and we have in our earlier expansion projects which we had announced, and going forward, we have a full capability of making EV tires in the commercial space, which is CV, with truck and buses, and even in the passenger and 2-3-wheeler. We have the full range of products, and we will have the compatibility of making these tires in these new projects as well. Well, in our we have witnessed in 2-3-wheeler space growth in this, and even in the PCR it is picking up, and we are also supplying our EV tires to 20 OEMs, and presently having good volume going forward and currently. It is, and we have also, namely in the passenger, we have the HPE, which is the EV tire, and in the commercial tires, JUXE in the bus segment, and E-Blaze for the 2-3-wheeler segment. And these are these EV tires. Plus, we are participating, as I said, with the OEMs, the largest OEMs being JBM and Tata Motors, and we are very closely working with Tata Motors, Ashok Leyland, and also VCV in the EV front. Well, right now the market is small, but we are doing some bits of numbers in the replacement markets and the OEMs.
Okay. And also, sir, we are exporting?
We are currently not exporting the EV tires. But we will explore.
Plan further? Yeah.
Yes, we will explore as the EV market will evolve. We will explore the export market as well.
Okay, thank you so much.
Thank you. The next question is from the line of Marcel, an individual investor. Please go ahead. Marcel, are you there?
Yes, sir.
Please go ahead.
Yes, sir. 1 second. My first question is regarding this Bagmore, this capacity plant. So what was our capacity utilization during this quarter?
One more tire capacity utilization level.
95% utilization.
Plus. How much?
95% plus.
97%.
95 plus.
there is a bit confusion here because what I've seen in this press release that this with this 312 crore we have expanded our capacity by 12 lakh units. But then they are again increasing by the similar 31%, but the capital outlay is almost double from not 312 but 617 crore. What is the reason for this one?
So you are talking about the capex investment or you are talking about utilization?
No. I am talking about capex regarding this Bagmore plant, the second phase. In the first phase, we have increased the tire capacity from 39 lakhs to 51 lakhs. We are at a cost of 312 crore.
Right.
And like this increase by 31%. And in the phase 2 again we are increasing capacity by 31%, but the capital outlay is not 312 crore but 617 crore. Why?
So as I have been saying in all the calls this point is raised that the debottlenecking program and the balancing programs are the reasons for our lower capex earlier which we had undertaken. And now this expansion further is a full kind of a brownfield expansion plan. Right?
So you are saying that okay. So let me tell me this one.
And also let me complete.
Okay, no problem.
And also over the last 2 years the costs have gone up, and some cost element increase is there, and also because now there are a couple of equipments which were not required earlier in earlier expansions. Those equipments are also going to be installed this time. So that is the reason for increasing the capex cost.
So in the first phase, the number of units increased by 12 lakhs, right? And
total expansion earlier also in the first phase was almost about 16 lakh. In the second phase also was about something of that number. And now it is 20% of the capacity, 19%. And this also includes not only the passengers but also some other areas, other segments.
That's fine, sir. But sir, in the first phase, we increased capacity by 12 lakh units, which was 31% of 39 lakhs. Right?
Can you please discuss this separately with me? I will explain and clarify.
Your good name, sir? Your good name, how to reach you? On which number?
Sanjeev Agrawal. You can reach out to me through email. I will reply to your answer.
Okay. And my second question was that regarding this employee cost. As has been mentioned by the previous participant, means we can see that as compared to September 22, our revenue has gone up by 10%, but employee cost has gone by 30%. And the reason explained by the management team was in the sort of excuse. Sir, it's a humble request. There is no need for any excuse. We need some concrete action. As we can see, a leading company like Wipro Limited, their profit was down. Their executive chairman Rishit Remji has taken lower salary. Their CEO has taken lower salary. So what I'm saying, to make annual increment is not a regulatory or is not like a obligation that we have to make increment every year. I think something needs to be done here because the employee cost has gone by 50 crore rupees. Has gone up by 50 crore rupees. So request to you and request to Anshumanji that I think going forward there is no need to give this en mass increment or the higher percent or it's mass we have to give increment, but definitely we need to see that how the profitability and how the revenue is increasing.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Shashank Kanodia from ICICI Securities. Please go ahead.
Yeah, good morning, sir, and congratulations for a great set of numbers. So just if you can share some thoughts of yours regarding the competitive intensity in the aftermarket. So was there any pricing action by us or by competition corresponding in the aftermarket for this quarter or near dates?
There was no such price increases in the aftermarket. But however, as in the earlier call, Anuj was also trying to explain, in the select categories in the aftermarket, we have increased our prices.
Okay, but sir, there hasn't been any price cut by us or any of the competition, or is it so?
No, there is always a competitive scenario in the aftermarket, and we are completely watchful and setting our prices accordingly.
But sir, has there any price cut been by the competition is what I'm asking.
Anuji, would you like to?
See, actually, if you say that, as Anshumanji was explaining, there are these market forces. So segment by segment, there would be, or even I would say geography by geography, there would be a specific, some offer, some scheme that is running. But overall, I would say that broadly the prices are maintained across most of the categories. And we also had done the similar thing. And for select segments, we have also taken some increases. So overall, if you see net in the replacement market, I would say it was maintained.
Okay. Second, sir, Sanjeevji, if you can share the raw material basket details in terms of procurement cost per kg for natural rubber, carbon black and synthetic rubber.
You want to ask me about the carbon credits?
No, sir, I wanted to have the raw material procurement cost.
RM basket.
Yes, RM basket.
We have already discussed the raw material basket. There is a correction by almost about 5% during the class.
Yes, sir, procurement cost for natural rubber, carbon black, if you can share. Per kg.
That individually is not readily available with me, but you can send me a query and I can reply to that.
Right. And so this RM basket is up 3 to 4% for this quarter is also an indication from the management, right?
That's correct.
Thank you. Thank you so much.
Thank you. The next question is from the line of Siddharth Gupta, an individual investor. Please go ahead.
Yes. Good afternoon, sir. Sir, I wanted to know, have we decided on any price for the QIP, or are we going to wait for a better price in the coming months?
This, I think, is not the time to decide about the prices. We have to go as per the SEBI formula. So that we will discuss and decide at a later stage.
Okay. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Sagar from Retail Investor. Please go ahead.
Sir, what would be the revenue mix by market at standard?
Sorry for the interruption, Sagar. Can you please switch to the handset? Your voice is very low.
Yeah, am I audible now?
Yes, please go ahead.
Yeah. So what would be the revenue mix by market at standalone level? Hello?
The revenue mix at the standalone level would be comprising of OEM comprising of 30%, replacement 55%, and export nearly around 15%.
Yeah, and what would be the revenue mix by product line at standalone level?
In terms of the standalone, a truck would be 55%, passenger would be 32%, and non-truck bias will be 13%.
Thank you so much.
Thank you.
Thank you.
So team, I think we can just take one more question if there is any, otherwise we can close the conversation now.
As there are no further questions, I now like to hand the conference over to the management of JK Tyre for closing comments.
Thank you so much. So I would like to once again thank you everyone for joining us today for the conference call to discuss Q2 FY24 performance. Thank you, and we hope we have been able to reply to your questions to your satisfaction. Thank you so much, everyone.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.